I am representing BlackRock as a BYU extern. In this presentation, I will show you why investing with BlackRock will benefit your $1 billion pension fund. Really, to begin, there's really two things to think about when investing: is increasing your return and to reduce the amount of risk you're taking on. And in this presentation, I want to show how through asset allocation you can increase your return and decrease the risk you take on for your pension fund. So currently within your pension fund, started in 1990, you had an investment of $1 billion. The asset allocation is at 60% in MSCI World Equity Index and 40% in Barclays Aggregate Bond Index. 23 years later, today, in December 2013, your cumulative return was 287.74%. Your average annual return was 5.81%, which is fantastic. What I want to show to you today is how we can increase that and how we can make it less risky for you. So I want to recommend today an allocation of 20% of your portfolio to alternative investments, and more specifically into hedge funds such as equity long-short, event-driven, global macro, and multi-strategy. I'm going to talk about what each of these are and how this can really benefit your portfolio. If you look with me on the cumulative return chart down below, we see the bar graph represented with the y-axis on the left-hand side of the cumulative returns for these different assets, and the black diamonds represent the volatility of these assets, represented on the y-axis on the right-hand side. If we look at this kind of really gives you a bird's eye view into why investing in hedge funds is really going to benefit you. If you look at the top 4 performing assets here, the equity long short, the event driven, the global macro, and multi-strategy all highly outperform the ladder of the S&P 500, your portfolio now, MSCI World, and the Barclays. We see that if you allocate to these strategies, it's going to increase the return on your portfolio. But if we look at the volatility, which is represented by the black diamonds, these hedge funds have a much far lower annualized volatility in comparison to the S&P 500, your portfolio now, and the MSCI World, which again equates and says this will increase return and decrease the amount of risk you're going to take on associated with hedge funds. So first off, they do increase returns, they mitigate risk, they are actively managed investments, which is fantastic, meaning that you have a very skilled manager who is constantly looking at the market, looking at different returns and different ratios, and being able to best allocate their funds to retrieve the best results of the highest return and lowest risk. They have proven results over the years historically. They also have more flexibility in the strategies of investment, whether using derivatives, shorting, longing. They also outperform market returns. The cons associated with it is they are unregulated, which can get caused to performing different strategies which you may not be comfortable with. They also have high management fees, which is well worth it. Honestly, it has a great value for what they offer. And you know that your money is pulled together with only accredited investors, which can be con for your everyday investor can't invest there, but only those with making $200,000 or more or net worth of $100 million plus. They also require a large upfront investment, and the investment is long-term, meaning it's not very liquid. You cannot take it out like a checking account. So now that we understand that, I want to go into what's the best or optimal way to find the different weights on how we allocate to these different hedge fund strategies within 20% allocated to them. So we look at the efficient frontier, which really helps us optimize. The efficient frontier helps represent portfolios with highest expected returns with lowest risk. That we take portfolios with different weights in the different hedge fund strategies, and I can look at where we find the best performing portfolios with different weights. And to find the best one out of all those, we need to take the capital asset line, making a line tangent with the efficient frontier, using the risk-free rate as a y-intercept, which we use as a 3-month LIBOR rate of 0.23%. The tangency portfolio, where those two lines intersect, is the best portfolio possible, with the different hedge fund strategies weighted to certain levels. And I'll go into what those levels are, but this is the most optimal way for us to find how we can benefit the most from these hedge fund strategies. So I'm going to kind of help explain them really fast. So the event-driven hedge fund strategy seeks to take advantage of special situations that change the value or price of an underlying asset, such as a dividend or when a company reports earnings and how it affects the value of the stock price. And this strategy really tries to capitalize on those movements. Equity long short is simply that they take a long position and a short position, and the difference is whether those positions are long-term or short-term. It has a low net exposure portfolio and achieve long-term capital appreciation with moderate correlation to major market indices. The multi-strategy uses a variety of different best-performing hedge fund strategies. They are best for a long-term investment, as when one strategy that was performing very, very well over a long time started to decrease in its effectiveness, the fund manager has to allocate or reallocate their funds to those strategies that are best performing. So those movements are, or those investments are better for long term, and this provides a smooth cumulative return by diversification of the different strategies. The global macro invests in emerging market equities to get higher returns. We think as markets are increasing or have very positive macroeconomic effects, we can take advantage of those. So like I said earlier, the investment thesis is to invest 20% of your portfolio, your current portfolio. And of that, I use the efficient frontier to really take it apart and find out what's the best weights to get the highest return for the lowest amount of risk. And what I found was to take 2% of the total portfolio in equity long short, 7% in event-driven, 6% in global macro, and 5% in multi-strategy, and to reduce the amount of holdings to 35% in Barclays and 45% in MSCI World. And what I want to show you now is how doing this is going to benefit you tremendously and it's going to give great value to your portfolio. Then I have the blue line represents the old portfolio, or the current portfolio you have, and the red represents this new portfolio with a new asset allocation. And what these really graphs show us is some great insights. So the beta represents risk within a rolling beta over these 23 years periods. And if you would have invested in these strategies when you invested where you're at today, we look at the betas, and overall the beta is significantly lower in comparison to the portfolio you have now, meaning that you take on less market risk associated with it. And think about it, if you are reducing risks, you might ask yourself, is that going to hurt my returns? But we look at the rolling alpha, well, actually we have a higher alpha overall over the current portfolio you have now, which says that, you know, within upswings in the market, we're taking advantage of that, and we have here we're getting higher returns and lower amount of risk. If we look at a few more ratios just to really bring it home and really represent how beneficial this is, if we look at these Sortino ratio, which really is comparable to the Sharpe ratio of how much return we're given for a given amount of risk. So we are getting more return for the amount of risk we are taking on with our new portfolio, 0.61, compared to the old portfolio of 0.513. Now if we look at the down capture and up capture, it's also very telling of how beneficial this new portfolio can be for your pension fund. A down capture represents how much our portfolio is affected by downward movements in the stock market. So use the S&P 500 here, and if you think of it, if there's $100 decrease in the S&P 500, your portfolio now will decrease by $60, but the new one will only decrease by $53. And on the upswing, if the up capture, so if the S&P goes up by $100, well, I'm going to make $58 of that. Where with the new portfolio, you get $58 of that. But with the old one, you only get $49. You can see that overall that the new portfolio is going to give you a higher return and benefit you in the long run with allocating these 20% to the hedge fund strategies. So give a kind of the conclusion and summarizing thoughts. If you look at the graph on the bottom right hand side, the bar graph, the green represents the original investment, and the blue represents the investment or the portfolio today after those 23 years of cumulative returns. You have almost $3 billion, which is fantastic. You've grown it at 287%. But if you would have invested 20% in those hedge fund strategies, you would have been at 395%, which equates to 37% more. And in dollar terms, you would have got an extra $1.07 billion, which is a huge amount. Investing in BlackRock will mitigate your risk and increase your return. This allocation will help protect and grow your pension funds. And just kind of hit this home with you of what I talked about before is you look at your cumulative returns to compare to allocating to the new portfolio over the 23-year period. Cumulative return 287 to 396%. Average annual return from 5.81% to 6.90%. And annual volatility risk goes from 9.47 down to 9.11. Overall, this is a great opportunity for you to invest. We're happy to have you here and hope we can explain any questions for you. Thank you for your time and for your consideration for investing with BlackRock. Thank you.